Welcome to TheoTrade. This is Don Kaufman, and here we are doing the December 11th, 2015 TheoVideo report. This is going to take you into your weekend here. I'm actually recording this video when there is still an hour to go in the trading day because I wanted to bring you into really, I think, some insights and some areas of the marketplace you might not necessarily be aware of. And doing this live while the market's open over here, I think it's going to be much more effective. First, we'll kick it off here on this Friday afternoon, looking at the S&P futures, which, yeah, that's right, they're down 32 handles right now, just about 1.6%. The NASDAQ is the underperformer in the day, down almost 2%, but the Russell is right there with it. We are currently off the lows of the trading session, but we're absolutely threatening. And the number that everybody's looking at over here is, hey, listen, are the S&P is going to close above or below 2,000? But that's not what is important in today's trading session. Okay, the fact that we have an FOMC announcement is not what's important next week. It's what is going on right here, right now, inside of volatility. And I'm not talking about the VIX, okay? The VIX is, my predecessor's, really way of looking at risk. It's a lot of the guys that I actually kind of grew up around, they're talking about the VIX and so forth. It's age old looking at the VIX. The VIX it's dead. I mean, everybody sees the market's down right now, and then the VIX goes up. We're going to read a little deeper into this, and I'm going to kick it off by looking at the volatility futures. So the volatility futures can tell us a tremendous amount about risk in kind of the here and now. First of all, the volatility futures that you see quoted on this screen right over here on the left-hand side of Thinkorswim, so they're up $3.70. But you got to be careful because those volatility futures, they only have 5 days remaining to the expiration, which almost makes them ineffective. They become too kind of knee-jerk reaction to what's actually going on in the here and now. So anytime there's less than about 2 weeks to go in the volatility contract, stop looking at that front month volatility contract and back out a little bit in time. So to do that, you open up all your volatility contracts, and many of these vol contracts that are in here, these are like weekly volatility contracts. Get rid of them. Don't worry about them. Let's look at the primary volatility contract that's currently 40 days out. It's up, okay? And it's up quite handily. So it's up about $1.80 over here. But again, that's not even necessarily my focus. It's what is that volatility contract 40 days out, which is the Jan 2016. What's it doing versus the next expiration volatility contract? And that's the Feb. Okay, so let's just kind of get a feel for what we're talking about over here. I'm going to freeze the screen. This is exactly why I did this with still an hour to go in the trading day. We, have volatility flipping over right now. Typically, what you see in volatility contracts, is the shorter duration volatility contract. That would be the 40-day. The 40-day would typically be around, for instance, we'll give it a number of about 18. And then the further you go out in time, so you go, this is this is the 40-day contract, and then it jumps to what? The 68-day contract. That's a 6 and an 8. I promise you it is. And then it jumps out to where? Go another 30 some odd days out, and all of a sudden you got a 100-day volatility contract and so forth and so on. So what volatility usually looks like, it goes from 18, further out you go in time is 20, go a little further out in time, might be like 21.5. And the reason that volatility works this way is that the future holds more risk. So what's more uncertain? The next 40 days or what's more uncertain the next 100 days? And the answer is, 100 days, because there's more time, there's more uncertainty in that. Well, what's going on right now is the volatility futures, they've actually flipped. They flipped, and they're saying right now, risk is imminent, risk is here, risk is now. It's on, people. And this short duration volatility contract or shorter duration volatility contract has actually now eclipsed the 68-day contract. And that's again, you always want to look at areas like, anybody can tell you the VIX was up almost 5. That's not gonna help you very much. The volatility contracts are getting heated out there. Now, let me show you one other area. And this isn't perplexing at all. This one is as clear as can possibly be. This is something, again, I like to look beyond the obvious, and this one is definitely beyond the obvious. What you're looking at right now is a chart of what's called the VVIX. They're like, what's the VVIX? It's the volatility of the volatility contract, okay? And the volatility contract is exploding to the upside right now. That means the risk metric that measures risk, if the VIX is, again, and people always look at the VIX and so forth, but if the VIX is a pretty good, like, quote-unquote, fear factor, then this is how fast the fear factor is actually moving. And the answer is right now, it is on. Like, this is getting real quick. And the last time we saw this kind of action was, of course, our fateful day back on August. Okay, so August, we saw some wild trade out there. There's no doubt. And I'm not indicating to you that this is another, August 24th over here. Quite the opposite. Moreover, what I really am indicating to you is that risk appears to be prevalent. Okay, not only prevalent, but it looks like that this sell-off is going to get a lot more serious, along with a confluence of a bunch of other factors that are in play. But this, again, this VVIX, it's not just confirming risk, it's screaming it. Risk is in your face. And you got to go back quite some time. Like, this is just a 9-month over here. But you got to go back like 5 years to see these kinds of explosive moves. And you're going to see only a handful of times, okay, only a handful of times really in the last 5 years have we actually seen the VVIX take off to the upside. Every one of the times we took off to the upside, it was quite intense. Okay, back here, this is actually what they called the Ebola trade. All right, we saw some more intensity towards the end of the year. Obviously, this is August 24th of 2015. I mean, oh, heck, I got to go back a ways to actually see the VVIX take off to the upside like this. We're actually going to bring it up. That's right, ladies and gentlemen. 10-year weekly. It's crazy. All right. The VVIX, though, hasn't been tracked back quite that far. Nevertheless, here we are all the way back in 2012, and we don't see action like we're seeing right now. And that's exactly the point that I wanted to show you again and again. Volatility is coming back. Okay, now let's look into just a handful of individual stocks, because I'm telling you, individual stocks, it's not where it's at. Who cares what your individual stock is doing? This is about a market now. They're liquidating. Okay, there are, once again, 4 stocks that I'll point out, and I've pointed them out every single day this week. Facebook, Netflix, Google, Amazon. They're all getting clocked across the board. Google has been the strongest point in here. Google's only down right now about 0.75%. It's actually hanging in there, which you can look at this one of 2 ways. You can look at this as being extremely positive. Google's holding us together. Or you could look at it, if Google starts to fall apart, this sell-off could get very, very serious in a hurry. But you're getting what held up the entire S&P 500 this year. Okay? Those stocks are getting hit hard. And I'm not even counting Apple in here, because although Apple, it's the largest market cap out there, you're like, you gotta have some respect for Apple. Why should I? Because on a percentage basis, year to date, it's only up now 3.6% year to date. It's no Netflix. Okay, this is, again, year to date on Netflix over there, on fire. It's still up 140%. Okay, you look at something like Amazon. Again, the sheer magnitude of Amazon's up move has moved the S&P 500 higher. It's still up 108%, but it is definitely on the move to the downside in a big way today, down, again, over 2.5%. Keep these in mind. All right, now we got to look forward to next week. What can you expect when we are expecting Janet Yellen? Oh, you're going to hear that a lot. Well, I'll tell you exactly what you can expect. The volatility, okay, has expanded quite handily again. I mean, that's obvious in a 35-point down move in the S&Ps, but the volatility, it's expanding. Now we're looking as much as a 62-point move, and that's through Thursday of next week. I say Thursday because that's the expiration of the SPX. To get a full picture of the risk that's embedded next week, we go to the spiders. The spiders, they're actually pointing to, ladies and gentlemen, almost a 70-point move in the SPX is being priced in for next week. I love risk. It is on almost a 70-point move over there. Risk is back. Vol got jacked today to 27%. 27%. The last time we saw this, August, September of this year. So I'm pretty excited. Okay, going to actually sell some volatility into this. However, you be extremely careful. It's a Friday afternoon. What's Monday morning going to look like? Okay, you have to worry about what Monday morning is going to look like, realizing that your positions, okay, are going to oscillate vastly more next week. That's what this expected move is screaming to you. It's a $70 SPX move being priced in. Yes, I'm translating spiders, which is $7, to the SPX, which is $70. $70 move being priced in next week. Again, the theme is risk. It's here. All right, risk is here. Get ready for it because it's about to get real serious with the fact we have an FOMC announcement. I don't think that's neither here nor there because the risk, it's all being displayed prior to that announcement. Thanks a lot, everybody, for joining us here at the TheoTrade video report.